Stop scrolling. In the last 72 hours, one single decision inside Trump's inner circle just lit a fuse under the dollar, and the silver market is responding like a bank run already started. Here's the event. Trump is about to name his next Federal Reserve chair, and prediction markets just flipped hard toward a rate-cutting, Trump-aligned pick. That one move doesn't just change policy, it changes belief. And when belief breaks, paper money bleeds, and hard assets don't climb, they lunge. You're watching it happen in real time. Welcome to TO My channel. I'm your host, and in the next few minutes, I'm going to show you why this Fed chair announcement is not politics. It's the trigger that could force silver into a new pricing regime. Now listen closely, because the most important part is not the headline, it's what the headline removes. For the past year, the market has been clinging to one last assumption, that the Fed, under Powell, would keep a foot on the brake, even when inflation ran hot, even when deficits ballooned, even when the government's interest bill kept swelling. The brake was the idea that Powell would defend credibility. But Trump's pick threatens to remove the brake entirely. Powell's term ends in May 2026. That's not far away. And Trump doesn't need to fire anyone to change the entire direction of the central bank. He just needs to replace the driver. And right now, the betting markets, where people risk real money, not opinions, are screaming that the replacement is likely to be a dove, a rate cutter, someone aligned with growth at any cost, optics first economics. That is why the odds have been surging. That is why traders are repositioning before the announcement even drops. And that is why silver is acting like it's already been made official. Because markets don't wait for ceremonies. They trade the future the moment the future becomes likely. Here's the first cliffhanger you need to lock in. The day Trump announces the nominee, you effectively get a shadow Fed chair, not officially in power, but powerful enough to rewrite expectations instantly. And expectations move faster than policy. That's the mechanics. Now let's talk about the signal the market already sent. The paper silver price just ripped to fresh highs. Big move, loud move, the kind of move that triggers media segments and chart screenshots. But that's not the story. The story is what's happening outside the paper casino. Because while the Western paper price prints one number, the physical market in Asia is printing another. And the spread between them is not a premium, it's a warning label. In Shanghai, physical silver has been trading far above the Western paper price. Japan has been clearing at similar levels. Other hubs have been quoting even higher for immediate delivery. That matters for one reason. Shanghai is where reality shows up first, because it's closest to manufacturing, refining demand, and the industrial supply chain. When a paper market says one thing, and the physical market says another, there are only two possible outcomes. Either paper reprices higher to catch reality, or paper loses authority, and a parallel price becomes the real price. And we are closer to that second scenario than most people understand. Now I know what some of you are thinking. Okay, but isn't this just another spike? Haven't we seen hype before? Fair question, but here's the difference. Hype doesn't shut down dealers. Hype doesn't force wholesalers to go no bid. Hype doesn't drain inventory while metal flows east like it has a one-way valve. This is not a meme move. This is a liquidity problem. Let me explain what that looks like on the ground. When the price moves violently higher, you'd expect dealers to celebrate. You'd expect everyone in the chain to restock and ride the wave. Instead, you get the opposite. You get product disappearing. You get common items becoming scarce. You get dealers either raising premiums to painful levels or refusing to quote at all, because many of them don't know what their replacement cost will be tomorrow morning. And then comes the real tell. Wholesalers go no bid. That phrase sounds boring, but it's a siren. No bid means a wholesaler refuses to buy metal at any price. Not because they don't want it, because they can't finance it safely. And when the middle layer freezes, the entire pipeline locks up. Dealers can't confidently buy from the public, because they can't confidently offload. Inventory stops circulating. Liquidity dries up. This is exactly how a bank run looks, just in metal instead of deposits. Depositors show up. The bank has assets, sure, but not enough immediate cash. Buyers show up. The market has paper claims, sure, but not enough deliverable metal. Same movie, different costumes. Now let's connect the dots to the Fed chair trigger, because this is where the story turns from bullish to systemic. Silver is not just reacting to demand, it's reacting to trust. The entire fiat system runs on one fragile agreement, that the currency will hold value better than the alternative. When that agreement weakens, when deficits rise, when debt expands, when rates are forced down to keep the government solvent, people don't calmly rebalance. They sprint. That sprint has a name, the debasement trade. And here's what the market is seeing right now. It's seeing governments spending money they don't have. It's seeing debt issuance that requires rates to stay low, because high rates would make interest costs politically and mathematically unbearable. It's seeing a central bank that under political pressure could lean toward cutting, easing, and reflating. In other words, it's seeing the currency's purchasing power become the sacrifice. And silver thrives in exactly that environment, because it's one of the few assets that sits at the intersection of money and industry. Gold is money, copper is industry, silver is both. So when confidence cracks, silver doesn't just rise as a store of value. It rises because the industrial world also needs it. Solar, electronics, energy systems, and strategic tech. It's demanded from two directions at once. That is why the moves become explosive. Now let's talk about why Asia is paying up, because that's not random either. Asia doesn't treat silver like a hobby, it treats silver like a component. If you're manufacturing high-tech goods, you don't care about a chart, you care about securing material. And when governments begin signaling that strategic materials will be controlled, prioritized, and sometimes restricted, buyers front-run the controls. That's what you're watching. You're watching industrial and strategic demand collide with financial demand, while the paper market tries to pretend it's still in charge. And that collision is where the so-called $1.7 trillion risk comes into view. Let's be precise. The physical silver market is not a multi-trillion-dollar pool of metal. The metal itself is comparatively small. The multi-trillion exposure lives in the paper universe. Futures, options, swaps, leveraged products, derivatives layered on top of derivatives, claims on silver, not necessarily silver. And that's the problem. Because paper can expand infinitely. Metal can't. When the physical market starts trading at a materially higher price than the paper benchmark, the paper ecosystem starts to wobble. Why? Because the paper price is used for settlement, collateral, hedging, and valuation. But the physical price is used to secure supply. So you get a split. Financial contracts priced on one reality, industrial procurement priced on another. And when the split grows, someone gets trapped. Either A, the paper price is forced to gap higher to close the spread, or B, the paper market tries to hold down the benchmark and physical drains until the system can't meet delivery expectations. Scenario B is where forced cash settlement becomes the ugly outcome. Not because anyone wants it, because the exchange has to protect itself when the metal isn't there. And that's why this moment is different, because it's no longer just bullish, it's a credibility contest. Now here's the second cliffhanger. The Fed chair announcement can accelerate this split overnight, because the moment the market believes rate cuts are coming, the opportunity cost of holding metal drops, the dollar weakens, and the flight out of paper accelerates, and silver already under strain becomes the pressure point. So ask yourself this. If the market is already showing signs of wholesale stress, what happens when a political catalyst adds fuel? This is why you're seeing behavior that looks irrational if you only watch the Western paper chart. It's not irrational, it's preparation. Now let's zoom into the shadow chair effect, because this is the lever most people ignore. Powell could still be in the seat today, but if the nominee is announced and clearly aligned with aggressive easing, the market starts trading the next regime immediately. That means currency traders sell dollars, bond traders reprice yields, hard asset buyers front-run the purchasing power decline. And silver, because it's thinner and more supply-sensitive than gold, can snap upward faster. The market doesn't need the nominee to sign anything. It just needs the nominee to exist. That's the psychology of regime change. And once the shift is recognized, it becomes self-reinforcing. Dollar weakens, raw metals rise, more headlines, more demand, tighter physical supply, bigger premiums, more distrust of paper, even more physical demand. That loop is what turns a move into a panic. Now I want you to understand the exact vulnerability in the distribution chain, because it explains why no bid shows up during rallies. Most wholesalers run hedges. They buy physical, then short paper to neutralize price risk. In a stable market, that works. In a violent upside move, that hedge becomes a cash-eating machine. Because a short position bleeds as the price climbs, and the exchange demands margin cash daily. So the wholesaler is sitting on physical gains, but they can't freely use those gains because they need liquidity to meet margin calls. It's the classic trap. You're right, but you run out of cash before you can enjoy being right. So the wholesaler protects itself, the only way it can. It stops quoting. It stops buying. It freezes. And when enough wholesalers freeze at once, it looks like the market is out of product. Not because the planet ran out overnight, because the financial plumbing broke. That's what a systemic squeeze looks like from the inside. Now, if you're still with me, here's the big question you should be asking. Is this the moment the paper benchmark finally loses control? Because if it is, then what you think of as price becomes meaningless. The headline number becomes theater. The real price becomes whatever someone must pay to secure metal now. And that's why Shanghai matters so much. It's telling you what urgency costs. Now I'm going to lay out 3 endgame paths, and I want you to notice something. All 3 paths punish paper and reward scarcity. Scenario 1. Paper capitulates. The Western benchmark gaps higher to match physical reality. The spread compresses. The premium shrinks, because paper finally admits the market is tighter than advertised. That's the clean outcome. It would likely be violent, but it's conceptually simple. Scenario 2. A permanent split forms. Paper trades as a leveraged speculation tool, while physical trades at a structurally higher level through private channels and non-Western benchmarks. That's messy, but realistic, because trust once lost is hard to restore. Scenario 3. The delivery crisis. The exchange cannot satisfy delivery demand at scale, and the system protects itself through forced cash settlement, emergency rule changes, or other stability measures. That's the nuclear option, because it tells the world, in plain language, paper claims are not metal. If that happens, the credibility damage is permanent, and the physical market becomes the only market that matters. Now here's what makes the current moment so dangerous for the old system. Trump's Fed chair pick can accelerate every one of these scenarios, because it speeds up the debasement trade. It pulls forward rate cut expectations. It adds political pressure to monetary policy, and it signals to the world that defending the dollar is not the priority. Whether you love that or hate that politically is irrelevant. Markets don't trade your feelings, markets trade incentives. And the incentive under a dovish regime is to run from paper and into real. So what do you do with this? First, I'm not here to tell you what to buy. I'm here to tell you what game you're in. And the game right now is not silver up, silver down. The game is paper promises versus physical constraint. If you own physical, you're holding the asset that cannot be printed, cannot be diluted, and cannot be created by a spreadsheet. If you're relying on paper exposure, you're relying on the system behaving politely during a stress event. And stress events are when systems rewrite the rules. Second, understand the next week can get chaotic. You could see margin hikes. You could see sharp pullbacks. You could see headline whiplash designed to shake weak hands. Volatility is not a signal that the story ended. Volatility is often the weapon used when the fundamentals can't be changed. So if you see a violent downtick on paper, ask one question. Did physical premiums collapse too? Because if paper drops but physical stays bid, the drop is just paper theater. Third, if you're watching for the trigger, it's the nominee announcement. The moment that name is official, the shadow chair trade becomes the main trade. And that's why this is moving before the press conference. Now here are 2 questions I want you to answer in the comments, because your answers tell me how the audience is thinking. Do you believe the paper benchmark still controls the price, or do you think Asia is already setting the real floor? And second, if the spread between physical and paper keeps widening, what do you think breaks first, the paper price jumping higher, or the paper market changing the rules? Now, quick and simple. If you want more breakdowns like this without the mainstream spin, subscribe to TO My channel. Short, effective, and it helps the channel reach the people who actually want the real mechanism, not the noise. Because this isn't just a silver story, it's a trust story. And trust is the foundation of every currency, every bond, every promise inside the modern financial system. If the next Fed chair is truly aligned with aggressive easing, the market will not wait for May. It will reprice now. And silver thin, strategic, and already under physical stress could become the loudest alarm on the entire board. So stay sharp. Watch the announcement. Watch the spread. Watch the no-bid behavior. Because when the financial world pretends everything is fine while physical markets scream otherwise, that's not a normal cycle. That's the moment the system shows you what it really is.